Hey everyone, in this video we're going to work on workbook exercise problem AP3B. And in this problem we're going to be looking at some closing entries. And one of the mnemonic devices that I believe is useful here in our course relates to the closing entries here. And that mnemonic device is basically REID, R-E-I-D. So if you can remember those letters, just to have this as a kind of a word association thing. What these stand for, the R is revenue, the E is expense, the I will be income summary, and then the D will be draws. And remember, we're using draws as another word for withdrawals, essentially. So what we want to do with this mnemonic device then is allow it to guide us through the journal entries for our closing entries, essentially. And so the first journal entry we're going to make is to close revenue. And then the process of closing an account is essentially just doing the opposite of what that account's current balance is for the same dollar amount, to zero it out, essentially. So, and what it's going to be doing is zeroing it out from the account that it's currently in, and the ending impact or the effect of these closing entries is going to be essentially moving all of these balances into capital through the closing entries. So let's take a look at how that works. So again, what we want to do is basically kind of reverse the balances down to zero, if you will. So let's start with revenue. So we can see that revenue is a credit balance of 7,600. So in order to essentially reduce that or close it, we're going, whoops, let me make sure I can select in there. We're going to, geez, bear with me for a moment. There we go. We're going to debit that account. So it currently has a credit balance. We want to debit that. And the amount that we debit for whenever we're closing is just the same balance that it has. It currently has a credit balance, so we're going to debit that. And when we debit the account, it brings it to zero, basically. And then we're going to use the income summary method. And so for each of these closing accounts that impact the revenues and expenses, we're going to close those, if you will, into the income summary account there. So as you can see, again, we started with revenue. Revenue has a credit balance, so we need to debit that. We just debit it for the same amount that it had prior to closing. And now after we do this closing and we've done a debit entry, it essentially goes to zero. And this balance that was previously there basically is moved into this temporary income summary account. And then the total of the income summary account moves into capital. Okay, so that was revenue. So that's the R in our mnemonic device. And then we're going to take care of the expenses. And so the expenses here, all of the operating expenses and whatnot, every expense essentially has a debit balance. So we are going to want to credit these. Now, revenue had a credit balance, so we debited it to close it. Expenses have a debit balance alternatively, and so we're going to credit those. We're still going to use income summary, but that's going to be our debit this time. And instead of debiting the like we did with revenue, we're going to credit, like I said, to get rid of the expenses, or I should say close those. So let's just select all of our expense accounts here. And so again, we're going to credit each one of these, and we can just link over because we're just grabbing the same balances. We're basically just reducing those to zero. It was a debit. Now we're crediting those down to zero. And then let's auto summarize all of the expenses together. Those will get debited to income summary, and we'll say close expense accounts. And then, so that takes care of our E in our little mnemonic device here. The next thing is the income. We're going to close the income summary account specifically now. So the way that we close the income summary account, let's make a little T account just so I can kind of illustrate this with Excel here. So as you can see, when we did our first closing entry here, and let's put income summary, we credited the income summary for $7,600. Then we debited it for $3,960. So as you can see, we've got a difference now, and we can find out what that difference is just by taking the 7,600 minus 3,960. We have a difference of 3,640. So if we're gonna close the, and let's do it like this here. Oh, sorry. You know what? Actually, let me do that again. Let me put it on this side. So we've initially had a credit, then we debited the income summary. So we have 3,640 as a residual debit balance, or sorry, credit balance. So now in order to close the income summary account, we just need to, again, kind of similar to what we do with revenues and expenses, we just do the opposite of what it currently has as a balance and for the same amount that it would have otherwise. So now when we credit, when we debit the income summary, it's now going to go to zero, basically. So that all goes away. And so we're going to, and one way you can do this without having to draw out the income summary T account, for example, is you can just look at the entries above and you can see what side, to make this zero, what would we need to do, debit or credit? You can see that the credit is higher. So in order to get these debits and credits to match just for the income summary account, which is to basically zero that account out, we can see here that we need to debit the income summary. And now when we add these two debits, we see 7,600, and then we can see a credit for 7,600. So that kind of balances us out. So that's one way to do this without having to go through the process of drawing out the T account. Okay, now, whoops. We're going to, so we're debiting income summary to close it, and then we're crediting the capital account to increase it. Remember that since we had, this is basically what we're saying here is revenue is greater than expenses. So we had 36, what this also represents besides just closing these accounts is that is net income. If we were to look on the income statement, 7,600 minus 3,960 in expenses would be 3,640, which increases our capital, and a credit is an increase to capital. Okay, so that's closing our income summary. And then the last thing we have to do is just close draws. We don't use the income summary anymore for draws. We just go in here and again, we just do the opposite. So draws has a debit balance, so we're going to need to credit that. And we're just doing it for the amount that it has. It's going to be closed now. And then capital, it always does that. My spreadsheets are a little funky with that. So sometimes you got to click the little comma, puts it in accounting format, and then you can do a link a little easier. And I prefer to do that instead of retyping everything. And then you can see we're reducing capital for the draws, which hopefully makes sense to you at this point in the course. We've talked about capital and what makes it go up and down quite a lot. And so remember that withdrawals is taking money out of the business, reducing the business's equity or capital, whereas earning net income increases capital. So that's what we can kind of see here is this is net income that increases capital. That's when we kind of condense this all down into the capital effect. And then a debit to capital is a reduction in capital, and that's because we're taking money out of the business. Okay. And then to finish this problem off, we need to prepare the post-closing trial balance. And so the effect of all of these closing entries essentially has been to zero out all of these accounts, right? These are all the temporary accounts that we just closed with these closing entries here. And so now we're going to bring down with our post-closing trial balance. We're going to update this and it will no longer have any of these temporary accounts because those have been closed. That's basically the effect of all the entries here. But everything else, as far as assets and liabilities, don't change. We can just bring those down, link them in, makes it easier, drag it down. But then capital will have changed for all of the entries that we've done here. So we can kind of show that. Let's just look at the math here. We're going to say this is our beginning of capital, 22,360. And then we increased it. It was a credit balance. We credited it. So we want to add. We're going to put a plus for the 3640. And then this is a decrease with the withdrawals. So we're going to minus the 4,000. And the net effect here you can see is going to be that capital is going to go down by $360, it looks like. So increase, decrease. We took more out of the business in terms of the owner taking money out than we earned in this period. And so capital is going to decrease a little bit, down to 22,000 there. And then let's just add these two columns up to make sure that we still balance, and we are looking good. All right, well, thanks everybody. That's our first look at closing entries, and I think we have some more examples here in the upcoming problems, so I will see you in those videos. All right, thanks. We'll see you there.